All opinions expressed by the Kendall Report participants are solely their opinions and do not reflect the opinions of VPM Partners, and may have been previously disseminated by them on television, radio, internet, or another medium. You should not treat any opinion expressed on this broadcast as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of an opinion. Such opinions are based upon information that the Kendall Report participants and Robert Kendall consider reliable, but VPM Partners does not warrant its competence or its accuracy, or should it be relied upon such. The Kendall Report participants, VPM Partners officers, directors, employees, contractors, guests, are not under any obligation to update or correct any information on this broadcast. The Kendall Report participants are professional traders or investment advisor representatives who may be actively involved in securities herein on behalf of themselves, their companies, and their clients. Also, the opinions expressed by the Kendall Report participants may be short-term in nature and subject to change without notice. No part of the Kendall Report participants' compensation from VPM Partners is related to a specific opinion they express. Past performance is not indicative of future results. Kendall Report participants and VPM Partners do not guarantee any specific outcome or profit. You should be aware of the real risk of loss and following any strategy or investment discussed on this broadcast. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned in this broadcast may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as recommendations appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this broadcast. Before acting on the information on this website, you should consider whether it is suitable for your particular circumstances and strongly consider seeking personalized advice. Nothing contained in the Kendall Report broadcast or VPM Partners on its website or in its written materials constitutes a solicitation, recommendation, promotion, endorsement, or offer by any particular security, other investment product, transaction, or investment. Copyright 2017 VPM Partners and the Kendall Report, all rights reserved. Terms of use apply. Reproduction, adaptation, distribution, public display, exhibition for profit, or storage in any electronic media in whole or in part is prohibited under penalty of law.
Now, for your host, Bob Kendall.
Welcome, everyone, to the Kendall Report for Monday, January the 14th. So half of this month is already over, and those of you that read my commentary, I know, is ripping pretty hard on the asset allocators, but I just keep seeing all types of things out there, people that call themselves research departments, and all they do is state, typical cliches about how January goes, the year goes, and all that kind of stuff. No real research. I've had the opportunity to work in one wirehouse environment as a research analyst with Merrill Lynch and with a regional firm, which I was the head financial analyst. So I've been around, seen a lot of I guess, analytics going on. I've been doing this for, this is 40 years this year, which is amazing in itself. But there's just a lot of complacency and a lot of trying to just mitigate what's actually happening into somehow this is all normal. And, I got into quite a, I guess we'll call it a rampage in commentary talking about just a number of elements. And I'm actually going to go through that on the opening dialogue this morning and just cover, actually the last two commentaries have been, in my opinion, pretty significant. There's some points I want to be able to bring out there. So before we go through that, let's just take a look at what's coming out this week. Earnings starts this week. There's a bunch of, the banks are coming out. Cities already come up and missed. Markets obviously lower right now and just kind of waffling around. The buy the dippers were around for the early morning losses, and they brought it back about halfway. But anyway, there's literally tomorrow we got PPI, which I feel like is one of the more significant things to look at here as far as what the Fed's focused on and inflation and all that. We're looking at consensus to be down a little bit on the producer price index. So there's not a lot of economics that are going to drive the markets. I think it's all about the banks this week and earnings. And there's something I brought up, which I'll go through in a few minutes, but the ECB is threatening to raise rates. So we'll talk about that in a minute. But as we go through on Wednesday, pretty much housing market. We've got retail sales. I don't think any of this is important. On Thursday, housing again with the starts coming out. Really nothing going on. Fed balance sheet. It's funny because we'll go through that in a minute, but who knows what's in the Fed's balance sheet and what its valuation at. And on Friday, consumer sentiment and industrial production, nothing material there. But as we get into looking at the earnings on the banks, that will be what drives the sentiment this week. So let's go over and take a look at something here, and let's take a look. And I want to go through last Friday's commentary briefly, and because I think there's some really big things that are happening, and I think, in my opinion, there's a lot of folks that are just not focused in on the right aspects of the markets, in my opinion. So let's just make this a little larger so you can see it. But I talked about, is the Fed really softening its strategy? Everybody's focused on interest rates, and Chairman Powell made something really interesting, the other day, and he was talking about the balance sheet and how it's going to be a lot smaller. Well, how's it going to get smaller? They're going to have to sell treasuries, right? They're going to have to liquidate the mortgages. They're going to be big time sellers in the market. The problem is the Treasury doesn't have enough money to pay back these treasuries, so they have to raise money to pay the Fed. Isn't that interesting? And so we're really looking at some crazy situation here, and it's called QT, which is a quantitative tightening. This is going to have a much larger impact than interest rates rising is going to have. In fact, interest rates could stay in a range. I'm still just absolutely, I don't know how to even describe how we got all the way back into the 250 ranges from 3.25. I'm still unsure of that. I still have a belief that a lot of that was foreign buying, and a lot of it still has to do with Brexit, which is continuing to be a real cluster, to say the least. But as far as we're looking at the numbers, the unemployment numbers were off the map in December. Maybe those will change as we get into go through this month and we see the January numbers early next month in a few weeks. But the bottom line is that it's the Fed balance sheet that we have to watch. We have to watch what's going on and see what type of activity is going there and what's going to drive the markets down. So if you remember, they stopped reporting what's going on with the balance sheet. They were way behind the power curve and where they said they wanted to be. But Powell made it very clear they're going to be selling big time on this stuff. And my best estimate that I've come up with is probably somewhere between $2 trillion and $2.5 trillion is going to be the place where we're going to be looking at as far as where the balance sheet has to get down to. Let's face it, if we were to roll into a recession right now, there'd be absolutely nothing that the Fed would be able to bring to the table. They could lower rates, maybe, but no one's really going to care. That's just going to tell us that there's more systemic issues. I really think that they're stuck on the path that they're on. They're going to continue down this path. So let's talk a little bit. Let's go over to this morning's commentary, and I'm calling it the buy and hold media, because that's pretty much it. If you watch CNBC, I always call it the up days are yay days and hurrah, and you see all the commentary that's out on the street, how well January is going, even though we finished the worst year in 10 years in 2018. Now all of a sudden it's like they have no context. The line in the sand is 10/31, and somehow everything gets magically reset, and we have a new year, and now we can just talk about what's happened in January. And the market has bounced pretty strongly. At one stage we're about, I think, around 11+% off of the lows, which is impressive, but a lot of it was short cover, and we'll go through that as we get into the technical part of the show. But the bottom line is that these market participants out there are always the big up days are, yay, look, we're up. On the down days that everything's very serious. You could turn the sound off on CNBC or even Fox Business or whatever your choice is, and you can see what the conditions are in the markets, whether they're up and down, just by the expressions and the way people are carrying themselves on TV. And like I said, when your beliefs are around asset allocation, and that's the only way you think things work, it puts you in a very difficult situation when you're going down and the markets are in a bear market, because there's not a lot to say other than, well, this is how it works. And when it comes to people's money, and I've been dealing with other people's money for 40 years, and they don't care about these things. They don't care about being patient. They don't care about seasonality. They don't care about all these things. They just care about their money. Like, can you do something? And those of you that are VPM Partners customers, and that's why we have this dynamic process, and we're willing to go to cash and protect and be neutral. And two things happen when we go to cash is, one, we get to the point where we're neutralizing volatility, not just downside action, but the volatility. So you get these swings. I was talking to a friend of mine the other day, and we were talking about why the volatility is so high. And it's the volume's been pretty decent, but it's the spreads. And I've been seeing this since November, that the spreads are blowing up, meaning that the bid ask is wider than normal. It's starting to normalize. I saw some of the best volume and tightness of spreads on the futures for the first time on Friday. I've actually saw some pretty interesting numbers. They were starting to really tighten up a little bit, but that's why you also have seen that we've had some contraction of volatility, but it's the spreads that are the issue, and it's the willingness of the buyer and sellers to spread to what they're offering on those transactions. So that has a lot to do with the volatility and then the frequency that these trades are coming and flopping. That's why you see, I was watching one day, the S&P was down 10 and up 4 in like 3 minutes. And a lot of that had to do with buying, yes, but the spreads were just ticking up where it was causing the indexes to go. So I'm getting a little bit further down the rabbit hole than I wanted to. But I do want to just mention a couple other things. Is what if the ECB, the European Central Bank, starts to raise rates? Everybody's been worried about the U.S. and what they're doing. If the ECB joins in and starts to raise rates, which they're being pushed pretty hard right now to do just that, then that could really start to have some more global effect. I still believe, and I'll go through the interest rates here in a few minutes, but I still think we'll see the 10-year move back up between 280 and 290, maybe even 3%, and we'll stabilize, and then down the road, we'll see this thing start to, interest rates start to move higher. And as I've said many times, the Fed starts selling, they're going to push the bonds down, otherwise yields up. And so that's going to be the big effect. And I believe that's how they're going to execute the policy. So let's go ahead and dig into the technicals here. And as we look at let me start here on the daily chart. And what we see on the daily S&P, we're hovering right below this 40-period moving average. And what that's telling us is that we're right against resistance. I've been talking about the upward ABC on the short-term market, which is representing a upward wave 4. So I'm just going to draw this in so you can see this. So this is the way I'm currently counting this, and this is this right here. I'm just going to draw arrows. This is 1. This is going to be wave 2. This is wave 1 of going down of wave 3. And then what we got here is this ABC. Now I'm going to break it down into smaller increments just on this sequence right here. But this is right up to this moving average. And not only that, I have been drawing that on my charts inside a commentary, exactly how this thing's going to unfold. Now, the critical level is this low that we had over here, which is the low of wave 1, and there's a rule that says if you're in a 5-wave sequence down during this wave 3, which I have as projected in right now, you cannot overlap the wave 1 low, and that's 2603.55. And then the next leg down from here should be an acceleration heading down towards the 2200, should be another consolidation, rebound rally, and then another leg down. And all of this has actually happened much faster than I thought it was going to. I had originally talked about getting to the 2340, 2325 level, which we reached in December, sometime in February and March. So everything, the time scale has been moved drastically forward. So let me show you this most recent sequence, and this is where the wave 4 is. And so we got wave 1, 2, this is wave 3, and then this upward ABC. And I won't get into educating you on Elliott wave, but if you notice, wave 1 and 2 is very simple. Wave 4 then there's a rule of alternation where that's going to be much more complex, which we've seen, and it's going to be critical that we take out a couple lows. We need to take out this low over here is 24.25, and I'll go to the weekly graph in a minute, but 25.24 was last week's low, and that's going to be the critical level that we're going to be looking at this week. And before I go there, but I just want you to, so this ABC is going to be wave 4, and then we're going to get a move down, and this should represent down all the way down to this 2200 level. And the exact numbers, I'll show you here. I've got it on commentary, so exact numbers here are right here. So the 2603.55 is the trigger to change the wave count, which if that doesn't happen, then we're looking down at this level, this 2412, but we have expectations of further declines down to the 2282. Here it is right here, 2282 to 2134, and that's in the next 6 to 8 weeks. And like I said, this was not supposed to happen until second quarter of this year. But when you look at what's going on in the economy, I didn't really go through a lot with the government shutdown, but I do believe that is also coming into play here. From a market sentiment standpoint, is it the end of the world that we're shut down with part of it? Maybe so, it depends. If you're not getting your paycheck, it probably feels like it. And so what we're seeing is market sentiment is going to change substantially, I believe, in the next week to 10 days, and folks are going to start to get pretty nervous. And I said in commentary, maybe you're not a Trump fan, but if you haven't read The Art of the Deal, and the Democrats need to probably read that book really quick, because he's playing them exactly how he always plays these deals. And like I said, he's not going to come back to the table. And I think Lindsey Graham has asked him to reopen the government. He's like, no, we're going to get this fixed. And he's dug in pretty good. Democrats are dug in, and in the end, what it's going to affect is the psychology of the country, and ultimately maybe the economy, and it's going to flow through. And if I'm right about this wave count, right about what's going on, as we go over from this daily graph over to the weekly, this is really telling you a lot about the longer term aspects of the markets and ultimately the economy. And whether the yield curve inverts and whether it doesn't, we'll see what happens there. But this pattern that's setting up here is pretty negative. Now we've got, like I said, if we do trade through 2603.55, then the pattern's going to change, and I'm going to show you what that is going to look like here. Bear with me one second. I'm going to drag this over so I can show you exactly and draw this in. So this is the pattern here that I'm talking about. This is your wave 1, 2, actually 1, 2, and this is the beginnings of wave 3, which should end up something looking like this. And this pattern, you see we're being driven, the ppm1 is minus 0.74, and the average right now, that's the 10-week moving average, is right where we're trading. I've talked about this 100 times, but when you're the reason why I do the bottom-up analysis is the 40-day moving average is somewhat equal to the 10-week, and then the 40-week moving average is similar to the 10-month moving average. So they all work in hand. Many years ago, back in the 80s, I was trying to come up with a way to connect all the dots between short-term, intermediate, and long-term and confirm the analysis down the road, whether we were in a trending mode up or down, or whether we were in a large corrective phase, and also determining which chart has the most validity at any one time. Right now, it appears, I think, the intermediate is in play, and you can see right here, we bounced off of the, I put a cursor there, we did bounce off of the 200-week moving average. We just kissed that thing and it rallied all the way back to the 10-month moving average. My best bet right now is that we're going to see the markets stabilize here. I don't think for the next, like I said, 4 to 6 weeks, I think we could stay stable. But this week is going to be really critical. If we were to close under 25.24, then we're going to see an acceleration and a retest of the 20. There's a key number at 2400, 2480, and then the next level down there is 2425, and of course the lows were 2340, 46 and change. That's back to this 200-week moving average. This level will be retested. Sorry about that. Really sorry about that. Bear with me one second, folks. I thought I had everything shut off. Apologize for that. Anyway, this 10-period moving average is going to be the driver. It's got a really sharp downward move that's happening, and and you look at the ppm2 is at minus 0.50, and ppm up here where the 40-week moving average is just now starting to roll over. And so we're looking at this pattern most likely, and this is what I was going to draw in here. Is probably going to do something like this where we retest. Maybe there's a pattern that will unfold before we start to see this go a lot further down. So this is the pattern that you're looking at here, is that you're seeing a downward stair-stepping pattern to continue to unfold. This 10-week moving average right here is going to be the driving factor that's going to keep that down. So let's look at the monthly patterns real quick. And the monthly pattern, like I've talked about, the 40-month moving average, which is somewhat equal to the 200. Interesting enough, is the 200-week moving average, but that number is right at 2412. So that's going to be your support. Even though we printed down to 2346, that's going to be your number. So the two numbers that we're going to likely stay between is 2412 to 2649. And like I said, I don't see an acceleration happening, but this week will be key. If we can go down and close below 2524, that's going to be a big number to keep an eye out on. So let's go ahead and take a look at a couple things here, and let's go over and look at our database and just to see what's going on there. And what we're seeing here is that we've had about in the last, I guess, really since late December, the last 4 weeks have net been positive, and our database has moved from, on an overall database, up to about 20% from 9% at the worst in December. So we are seeing some traction come in. A lot of this stuff has been bonds and bond funds that have come into the database to make it look like it is, but we're not seeing any real big acceleration. Now, the individual equities are at 33% long, ETFs 26, and mutual funds still at 20, which is pretty close to where the overall database is. I'll show you in VPM 2.0 here in just a minute. But as far as the sectors go, and you're seeing some positive rotation across all the sectors here, bar none of them. They're all have some positive rotation. And then when you go down and look at the other dashboard, there's really, looking at the individual industry groups, you see some positive rotation going there in a number of spots. And a lot of what's happened is a lot of stocks got beat down pretty hard. I mean, there are stocks down 30+%, and I believe it around 30%, I'm sorry, almost 40% of the S&P 500 was down 20% or more, in some cases as much as 50%, and they were recognizable stocks. So I saw a story that I'm going to take a look at this, and it might be the way to go, is like how to make money this year is buy the stocks that got beaten down really bad last year. And you don't want to blindly buy those stocks. You have BPM, so you can put them in a portfolio. I'm going to see if I can build something around that concept just to see what's out there and see if there can't be an interesting recovery type strategy to go on. But as far as this stuff goes, we are seeing some positive rotation. It makes sense. The databases went from a 9% bullish to around 20. Let me show you where that is there. So you can see we're at 20.03. Right now, there's only one sector that continues on the intermediate basis to be long, and that is utilities. It's down about 4%. I don't think the bankruptcy in PG&E is probably helping that index a lot. That may be, if you eliminate PG&E, which is going to be filing bankruptcy because of the fires in that last year that destroyed just so much, and they were negligent, no doubt. So they're running for the hills trying to protect themselves. That's going to be an interesting case to watch, by the way, just from the standpoint of what happens when a major utility gets that much in trouble. They've had a troubled past anyway. So as we look at the database, you can see all the sectors are flat. If we flip over to the daily, and then you'll see a little different story. Now all of a sudden, on a short-term basis, 66% of the sectors are long, groups 59, and we're 51.24. So while this would appear to be bullish, it's interesting that just like with the weekly database, when this gets up to around 60%, where we are in some of the areas here, really signifies the top of this run. So you can see that the VPM universe chart over here, and that is showing a nice ABC. We went right up to the 40-period moving average on it, and we should start to see some retracement. And like I said, I don't see any way that we don't retrace this entire pattern. And one of the things that I talked about a few weeks ago is that there was a major divergence in that our non-weighted index that we built, the VPM index, was unable to make a new high when the S&P and all the other indexes were able to render new highs. And that divergence ended up to be an incredibly negative divergence. So you can see that, like I said, services just came on a daily basis, and you know it's starting to show some bottoming. That's got these different groups, and you can see a fair amount of these groups have open positions yet, and there's still, you know, we have real estate operations and retail technology is kicked in, but the bottom line is these are all very, I guess we'll call them background kind of stuff that's going on, and also short term. The typical short term cycle is between 37 and 55 days as far as what you're going to see out of our database. And like I said, we, you know, when you look at the full database here, you're looking at 17,575 stocks, and on a short-term basis, they're 51.24 as far as the bullish percent. So, like I said, we're closer to stalling out here than going up. Now, I have not really studied the short-term database at the level that I have the intermediate, but on the intermediate, anything over 42 is bullish. So as long as we manage to stay above that, we'll probably keep a general sideways pattern unfold, just like I talked about on the S&P just a few minutes ago. So we still, the way this thing is hovering around this 2600, there's about a 40% probability that we're going to see the 2603.55 triggered. If that happens, then we're going to get this big elongated sideways pattern. The good and bad of that is that we're going to see a lot of volatility, and we're not going to see any new trends emerge from this level, not at this time anyway. There's a lot of work to be done with the database 20% long on the intermediate basis here. Let me go back to the weekly database view. If you look here, we're 20.03. There is a ton of work to do. There's so many trends that were destroyed when during that last quarter of 2018 that it's going to take a lot of repair work to get that done. So let's go ahead and move on to the interest rates. Talk a little bit about that. I'm still amazed, actually, that I've got the monthly here. Let me go to daily. That the 10-year was able to decline like it has, and I continue to believe that this entire decline in the 10-year in the rates was actually a lot of European buying. And I talked about this a couple of weeks ago, is that the dollar was going up for the most part during this time. It's now stabilized at higher levels, but the dollar was going up while the interest rates are going down. Typically, that means that there is some sort of flight to quality and international bid coming into the market. So you can see on the PPMs here that we've got this pattern that's starting to unfold, and what we're looking at here is actually probably an ABC here like this that will go up to the 40-day moving average, which is around 285. And as I mentioned in the opening dialogue, I'm still expecting to see the rates move up back to 285, maybe as high as 3% over the next 6 to 8 weeks. The question is what the configuration is between the stock market and the bond market. And what we've seen is, you know, the the bonds really provided a reasonable amount of protection on it because of this big downside during that last quarter, but didn't offset a lot. If you look at 60-40 strategies and those type of things, there was some offset, and it did mute some of the downside action, but it was big enough that it certainly didn't eliminate it and soften the blow. But this here, I always try to correlate the markets from a, when you look at interest rates versus equities, you have to ask yourself, what is the cash flow? And if the cash flow is going to come out of bonds, maybe it's the Fed selling, so there could be some other aspects in here that I talked about earlier. But we're going to see, it looks pretty likely that we're going to move back up and ultimately probably move back up to the 200-day moving average, which is right at that 295 level. And it is declining, so that's going to be resistance 295. So I continue to expect to see this market just kind of hover between ultimately 275, 295, and we'll stay in that range until there's some evidence of what's going on and whether I'm right or not about this QT program, which is the quantitative tightening, which is the downsizing of the balance sheet. And so if we look at the intermediate charts, this same pattern actually emerges better. We're looking at all the PPMs are still really negative, and if you look at the patterns that are unfolding here, you can see this 10-period moving average is down pretty hard at 284. It's declining around four basis points per week. So that's going to be 280, and with a 1.67 downward PPM1, you'll see over here, that's going to tell you that there's like a 20% probability that we're going to be able to get over 280 until this number drops and bleeds off a lot. So we could see the range of 260, 275, 4 to 6 weeks. This is a weekly graph, and then you'll start to see the downward momentum start to bleed off and then set up a move, and then ultimately heading back towards these upper moving averages, which are in the range I talked about earlier at 297 and 294. Both the 21 and 40 are sitting right there. So that is certainly what I'm expecting to see happen at that point. If we go back and we go over and look at some of the yield curve stuff, you'll see all this stuff is pretty much stabilized. We have seen some steepening, especially in the 1030s. Those have been screaming, and some of the shorter term stuff is not as good. But you see here on this chart here, this pretty much shows you this flattening of the curve here. This is the 13-week T-bill, and you see this is the 2-year notes. We've come right down. They did cross a little bit, and we bounced back up. So they kind of hit, and they touched, and then they spread back out. So as far as the inversion happens, for the moment, it's not going to happen. And I suspect it may not, actually, and we start to see the 5 and 10-year start to move back up in the ranges, just talking about, about 20, 25 basis points over the next 6 to 8 weeks. So from that standpoint, there's not a lot going on. What I'm going to do today is I'm going to go through the Dow here, talk about the Dow, we'll do gold, and then at the end of this show we'll talk about crude oil. I realized something. I really messed up. Last week I did a video offline and had it all ready and realized it was uploaded, but it wasn't published. So we'll go through that. It was a snafu. I thought I had published it. I know it, sent it up there. But anyway, so let's take a look at some of this other stuff here. And let's go and look at the Dow. It's down a little bit, but I've talked a fair amount about this, and we really have hit a resistance point as far as the Dow goes. This is the weekly graph, so the intermediate. It's stabilizing here, and it's stabilizing just above the 200-week moving average. You got the 10, and 21, all right in this sector. You have right now the short term, the 10 ppm1 is negative, but minus 0.11. It's pretty much flat. ppm2 is 0.05. ppm3 is 0.1840. So there's actually, the underlying trend is really strong. And when we go over and take a look at the monthly graph here, you'll see that you'll see this 10-week or 10-month moving average is rising sharply at 0.71. That's going to be your support in the Dow. It's not going any lower. And the other thing I was talking about earlier, as far as this flight to quality in the bonds, the bond market dropping in yields while the Dow is going up, the same thing is happening in gold. Gold was going up while the Dow was going up. And so there's a flight to quality. There's some positioning going on. I think there's kind of a fear trade being put on, and I think that will continue. We'll go through gold here in a minute, but this market shows you it's got a lot of support. The other thing I want to point out here is that the upward objectives here, which are pretty recent, they are suggesting that the Dow index, which is heavily weighted, I think about 40% towards the euro, is going to 102 to 108. So we're still looking at upward projections on the Dow, and I suspect that it kind of lines up with, now that the rates have bottomed at this 260 level, we'll round off a little bit. We're now going to see the Dow stabilize here. Rates should start to move back up. The Dow will probably go with it, and it will be interesting to watch and see how the correlations between the Dow and gold and the stock market starts to play out. And it's kind of difficult at the moment to figure this configuration, but I suspect that the higher rates that this unfolds will represent lower equities, and interesting enough, the gold is likely to go up as well during the same period of time. As you know, I've been pretty bullish on gold. Around 1160, I started telling you folks that you need to be looking at that. If you put GLD in, like I told you, you've done quite well as far as the VPM models. They had gotten into that pretty at a pretty good level, just below the 1200 level. So let's take a look, and while we're talking about that, and let's go to gold next. And we're printing on the near futures 1290. And this pattern, to me, this is the monthly, is absolutely amazingly bullish. You'll see a couple little dots here, and those dots are the VPM cycle finder, and they came in. The first dot warns that the next cycle is coming in, and so we haven't seen a cycle on a monthly basis since 2014. So this is starting to push up. We're right here at these moving averages to get through there. We're looking at 1295, 1288, and we're trading at 1291. So once this thing gets above here, the next highs will be around 1375. I've talked a bit about this, 1375, 1390, and I think ultimately we see something really interesting, which will be a pretty big breakout on the upside for gold. So one has to ask, why would that happen? But let me mark this up and show you exactly what I'm talking about here. So this pattern here has been basically an ABCX ABC type pattern, which is this a consolidation. What we should see now is this. We should start to see this thing break out and start moving up. And I have talked about this before, but I think 1750, 1850 is going to be an easy run here. We've literally built a base since we'll call it mid 2013, and this base has just been sideways, and this is going to be a major run. Now I'm going to attempt to blow this chart up a little bit. Let me just see something here. There we go. Yeah, so on a larger scale then, what I'm expecting you could see is just this. So this whole pattern down here, really what we've set up is this. We should see a 5-wave sequence up. I think we could go to all-time new highs on gold. I'm not sure why. I don't know if me talking about this Fed balance sheet and the Treasury having to raise money to pay the Fed, which will be interesting in itself, and or whether we just everything kind of derails. And like I've said many times, we're one bad bond auction from disaster. So this would be my long-term projection on gold. You've got some hurdles here, roughly at this is the 1400 level. But once we get above that, it's clear sailing. There's all this stuff back here means nothing. You can draw lines here. Maybe we go here. Maybe you got the old highs. But once we break above this trend will start to evolve. You'll see all these PPMs start to really accelerate, and you already see nice slopes on this stuff here. There's some really, from a indicator standpoint, way back here was the worst on the short term, and here was the worst on the intermediate, and the long term hit its peak right in here. And so what we're seeing is this next phase, which is an impulse wave, and this was a perfect unfolding of 5 waves down to this low. And I got a lot of arrows going here, but this whole pattern is really substantial. And my best guess, why would gold do that? Well, this is going to be a big flight to quality trade, and I'm not sure where we end up. You see a lot of things coming out in the news. I mean, now they're saying Trump's like a Russian agent, which it couldn't be more ridiculous. He's working for the Russians. I don't know, maybe they play this dialogue out. Maybe they get him out of office. If they do, it derails everything. I talked about, some of the things with the social networks and all this stuff. They're trying to, I meant to talk about this earlier, but I'll do it now, and it's relative to here in gold. If you look at what's going on in Paris right now, and what they call the yellow jacket movement, they're now trying to get, everybody's following this movement to take all their money out of the banks, hoping to trigger a run on the banks. If they succeeded, wouldn't be that hard when you have, a fractional reserve system, and the bank is basically a Ponzi scheme anyway. It doesn't take much money to come out to actually trigger these things. If that happened, that would trigger across Europe and across the planet, and that could be the point that just rolls this whole thing over. Gold is going to be your go-to trade. So I will continue to suggest to you folks that you have GLDN or something like that. I'm going to go back just a step here, and let's take a look at that. I think on a weekly basis, let me put GLD in here. Let me turn on, I think it's 1.2. Yeah, here's the buy signal here at 115.72, and it's now 122. And I know all through that bottom I kept telling you guys, make sure you put, if you have an interest in this trade, that you have GLD on and you get this on. This pattern, curious to see. I don't think there's enough data on this platform. No, there is, but there's not. It hasn't had a long-term buy yet, and that. But this pattern, I just went and spent a lot of time on, is really, this is an explosive pattern. You don't own gold, you're going to hate yourself. So I tell you, down the road. I hate to sound like Peter Schiff, but he's been a broken record for 10 years since this whole thing topped out. But the bottom line is, you're going to want to own this stuff, and all this debt the national debt, all of the things that are coming. We're at a major inflection point. Whether they can manage it and get all of us to continue to believe in the system at the next level, we'll see. But there's definitely some flow going to happen here. I know I got a little long in the tooth there. Let's take a look now and take a look at crude oil. And we're going to start from the short-term basis. And you can see on crude, BPM issued a buy signal at $47. It's still long here. My guess is that we're going to see one more leg up, and that this momentum that we're seeing, we're at ppm 1.19. Anything over 0.25 is an uptrend. We haven't gotten those numbers to flatten out yet. On ppm 2 is at minus 0.02, which is basically not just flat, which tells you that what has already happened is that made the markets possible for them to move up. We're minus 0.27 on the 40, which is a downtrend. And you can see we went above it and we're coming back to this average. So we could run back to around 49.5 or so, but we should see one more leg up, which would put us somewhere up here, and I'll show you on the intermediate charts is where you'll see this trade. So on the intermediate charts, and in fact, on the weekly, it's still short at 68.30. So it's getting close to covering, but we're going to see this pattern unfold, and around 59 to 61, that's going to put us back into the weekly moving averages. That's where we're likely to go during this pattern. And the first thing would be to get over the 200-week moving average. That's at 57.12, so I believe we'll at least run to there, maybe spike above it, come back down. Meanwhile, the 21 and 40-week moving averages are going to continue to decline. Right now, 21 is at 60.47, and the 40 is at 63.66, and they are declining at a pretty good pace. So there's going to be a lot of overhead resistance. But, and this is the but is that this is a bottoming pattern that is setting up. So just in closing, let's think about what I've talked about on the show just a little bit, in that what we're seeing here is a very big setup for gold to advance. We still have the Dow looks pretty good. The interest rates look like they're going to go up. So I think there's going to be some liquidation going on there, which I believe will be the Fed doing QT, or quantitative tightening, through the selling of their assets on their balance sheet. But all this stuff is lining up pretty good that we're going to see. And it's interesting that crude oil looks like it's bottoming and going to move up. So we have gold, crude oil, some of the commodities start to come up. Does that mean there's going to be demand? No, maybe it means there's going to be a shortage or something. You know, we still got a lot of stuff going on in the Middle East. As always, it's always a hot spot. And I saw a story, and I don't know what the validity was, that the Trump administration was looking at ways to possibly attack Iran, which would disrupt the Straits of Hormuz, and all kinds of potential action there in crude oil, and change the supply and demand picture in a heartbeat, just like that. That geopolitical stuff is still out there. And so to me, it looks like things are lined up pretty good. Stock market going down, interest rates probably in a sideways range, 275 to 290. We've got crude oil should move up in the around the 60, 63 level, and then we got the forecast on gold looking like we're going to at least test 1,400, and most likely we're going to 1,800 and more. I'm going to do some more work, and so I don't see any questions, but if you folks need to remember, if you're on the show, if you have any questions, I'm glad to talk about markets or other things that you have in mind. So anyway, I'm going to sign off here. Thanks for watching, and hopefully this week will allow for some other types of broadcasts I do. Last week was kind of a crazy week for me, so I was really distracted. I had a lot of stuff going on. I think this week I can pull off maybe updating and doing some broadcast depending on what kind of volatility we get. So anyway, folks, thanks for watching. Really appreciate you tuning in the show. Make sure you subscribe. Thank you.